For 3 years, a soft landing felt inevitable. We watched generative AI propel the S&P 500 to heights that defied gravity, creating a market environment that felt almost bulletproof. But today, in April 2026, the cracks are widening. Microsoft is down 20% from its peak. Bitcoin just closed its worst quarter since the crypto winter of 2022, and the U.S. national debt has crossed a staggering $39 trillion. Look at your brokerage or retirement account, and you will see the shift. The rules of the everything rally have suddenly stopped working, leaving everyday investors trying to figure out why their balances are shrinking. To understand if a massive correction is imminent, we have to look past the daily tickers. We need to examine the 3 specific macroeconomic pillars that have been artificially propping up this market. Everyday retail investors now face a high probability of being left holding the bill as the market music stops. Pillar 1 is the AI reality check. For 2 years, NVIDIA and a handful of tech giants acted as the primary engines for the S&P 500. But in early 2026, investor psychology shifted. They stopped asking what artificial intelligence could do and started demanding immediate returns on their investment. The scale of capital expenditures, the massive outlays required to build physical data centers and acquire chips, has been immense. Microsoft spent over $37 billion in a single quarter strictly on AI infrastructure. This chart shows the rising trajectory of AI capital expenditures against overall S&P 500 revenue growth. While the infrastructure spending goes almost vertical, the broader market's profit growth has remained flat. The revenue has entirely failed to keep pace with the costs. When stock prices remain high without the profits to justify them, valuation multiples compress. The market forces tech giants to shed hundreds of billions in market capitalization in a matter of weeks to align their stock prices with their actual profit realities. The underlying technology is still functioning. What failed is the expectation that generative AI would act as an immediate, massive profit engine for the stock market. Pillar 2 is the debt trap. The Federal Reserve is caught in a gridlock. They are holding interest rates steady at 3.5% because inflation refuses to drop, remaining dangerously sticky at 2.7%. If they cut rates prematurely to stimulate the economy, inflation will roar back. But if they keep rates high, the borrowing costs on our $39 trillion national debt turn into a financial black hole. Looking at this pie chart of the U.S. budget, nearly 14% of total government spending is now consumed strictly by interest payments on that debt. That is capital drained away from infrastructure and innovation just to tread water. The Federal Reserve is now managing a mathematical reality where every policy choice carries a high systemic risk. Pillar 3 connects these high-level mechanics to the flow of cash itself. Bitcoin ended the first quarter down 22%. It serves as a canary in the coal mine for high-risk liquidity. When institutional investors pull their cash out of crypto assets, it indicates a desperate need for capital to cover losses in other sectors. The era of easy, abundant money is gone. For the average American, this sideways to down market movement hits alongside a tightening labor market. Unemployment is nudging up toward 4.4%, restricting income at the exact moment consumer debt sits at record highs. This triggers a reversal of the wealth effect. When everyday people watch their 529 college savings plans and pension funds drop by 20%, while still paying over 3% interest on their mortgages and credit cards, their financial confidence collapses. When consumer spending drops in a high-debt environment, the resulting economic contraction can trigger a broader recessionary cycle. Is a full market crash inevitable? We aren't looking at a 1999-style bubble burst, but a painful mathematical correction to reset valuations has already begun. Look at the difference in behavior. Retail investors are blindly buying the dip on overvalued tech. Meanwhile, institutional billionaires have completely rewritten their strategy. The smart money is rotating aggressively out of growth stocks. They are moving capital into private credit, securing guaranteed 3.5% yields in cash, and buying into defensive value sectors like healthcare and consumer staples, prioritizing companies with real dividends and low debt. They are also executing a heavy hedge strategy. By taking defensive positions in treasury bills and physical assets like gold, institutions are signaling that their current priority is survival. Institutional investors are systematically moving their wealth into defensive assets, prioritizing capital preservation over growth. This chart illustrates the first step to protect your wealth. Audit your exposure. If 80% of your portfolio is the Magnificent Seven, You are highly leveraged. Step 2. Reevaluate your emergency funds. Cash should sit in high-yield accounts, capturing that 3.5% yield while you wait for better entry points. Above all, do not panic. Markets do not go straight up. The extreme volatility we are seeing right now is simply a harsh return to a normal economic cycle. The next few months will severely test your discipline. The true winners of this correction won't be the people who perfectly timed the market bottom. They will be the investors who managed their risk and ensured they weren't forced to sell when things looked the darkest.